Hello everyone. If you're watching this video, we're assuming that you have already worked on the test 3 review and are ready to check your answers for that. So the information here in the Excel spreadsheet is what was given to you for XYZ, the balance sheet at the end of 2019. So we're going to do 2020. We're going to record sales. We're going to debit accounts receivable, credit sales. We're going to record depreciation expense, debit depreciation expense, credit accumulated depreciation. We're going to record amortization expense, debit amortization expense, credit the patent. If you want to use accumulated amortization, you may, certainly. Either way is acceptable. Interest expense, debit $8,400 to interest expense, credit cash, wages expense, paid in cash, debit wages expense, credit cash, and then insurance expense. $2,000 of it is for life insurance, the rest of it expired. So you've got credit cash, $2,000, debit insurance expense, $2,000, credit prepaid insurance, debit insurance expense for $3,000. Collecting accounts receivable, we're going to debit cash and credit accounts receivable. We're going to pay accounts payable. All right. We're going to debit accounts payable and credit cash. We're going to pay the income taxes that were payable, debit income tax payable and credit cash. We're going to make a payment on the note payable for $15,000, debit cash, credit note payable, debit note payable, credit cash. And we're going to buy some inventory, which probably should have been listed earlier, but debit inventory and credit accounts payable. Make the adjustment to make our ending inventory $56,000, which will allow us to calculate our cost of goods sold. Much of that was very similar to what we did on our very first exam. Now there is some issues that come from our material that we've covered more recently. We have stock options with a fair value of $4. That means that their total amount of compensation expense is $4,000. It vests over 4 years, so which means on every January 1st you're going to record $1,000, right? $4,000 over 4 years, $1,000 a year, and so that means that these were originally for 2018 were done, so we're at 2020. So $1,000 is going to be a debit to compensation expense and a credit to additional paid in capital. We buy back treasury stock, debit treasury stock, credit cash for 300 times 20. All right. We're going to record leased equipment, $3,000 a year, bargain purchase of $500. We're going to do that using the present value formula. Here is the calculation in the formula bar. 7%, 10 years, $3,000 of the $500. We do leases with at the beginning of the period, so we have to put a 1 at the end of our formula, and that gets us $22,799.87, rounded off if you're $22,800. Debit leased asset, credit lease liability. When it comes time to calculate some more depreciation, we're going to have to depreciate a half a year of depreciation on the $22,800 as well, which is going to be $1140. Debit depreciation expense, credit accumulated depreciation. We also have interest on that liability for half of the year, which is going to be $693. 7% for half on the amount. Now, remember, when you calculate the interest, the first payment was made for $3,000. okay, on the leased asset. And so that reduces the lease liability down to from $22,800 down to $19,800 before you make your calculate your interest and anything else having to do with that liability. So, but it doesn't affect your calculation of depreciation because that's based on the asset, not the liability. On November 1st, we resold the shares that we bought for $20. So we're going to debit cash for $2,500. We're going to credit treasury stock for $2,000, and the difference is going to go to additional paid-in capital as a credit. It is not a gain. And then we finally have a lease, a building with monthly payments, $2,500 per month for 5 years. So that's 60 payments. So we again are going to record that at the present value. So we do the present value like it says here. Present value 7. We have to divide that by 12 now because that's monthly, not annual like the other one. 60 payments, $2,500, nothing at the end, no bargain purchase. Okay, and then so it's still a 1 for at the beginning of the period. So we get $126,991 as the present value. That's a debit to leased asset, credit lease liability. You could have created a separate T account for each of the leases. I put them together in mine just so you understand. Okay, when we look at the T accounts. And then we pay dividends, debit, and we'll have to know how many shares we have outstanding before we can calculate the amount of dividends. But it's going to be $50 per share, or half a dollar. So we're going to make those journal entries. We're going to put them in the T accounts over here. And here you see the T accounts. A lot of transactions in cash. Got cost of goods sold, $165,000, and so forth. There's our interest expense, insurance, accounts payable. We haven't done our taxes yet, but we'll come back to that. And deferred tax liability, so forth. Here's our payment on our lease. Here's the interest. I put the interest in the lease liability. You could have put it as a separate interest payable if you so choose when you record the interest on the asset. Now, interest on the liability, the lease. Now this asset, the first leased asset, the equipment, is a finance lease. So we record interest, expense, and depreciation, which we already said that what that was, a depreciation expense. But the second lease asset is an operating lease, which means we don't record interest. We record the actual payments that we made to lease expense. So here are the lease expense payments of $2,500 for November, December. Now remember, next year you're going to need to do all 12 payments. Okay, but for this year we just do 2 payments, and then we calculate the new present value. And notice everything is the same except instead of 60 payments left, we have 58 payments. So we get a new amount, and we take the difference between the two, and that's a credit to the leased asset here and a debit to the lease liability. So that's how you do an operating lease. You record the lease expense, and then you calculate the new present value. And since we've just made 2 payments, we just do the 2 payments off thing. We could do that adjustment once a year. If we were doing it for a whole year, we could do all the months at once, typically, because we only do the financial statements at the end of the year. All right. Now, to wrap up our taxes, we need to get our income before taxes. So we have to do our income statement up to that point, and here's what that looks like. We get income before taxes of $48,767. Then we do our tax return, if you will. We add back the life insurance because that is not deductible. That is a permanent difference. We add back compensation expense because that's a temporary expense that is not allowed because it's an estimate for tax purposes. And then the difference between our depreciation, using depreciation for tax purposes for half the year, and our depreciation we recorded on a straight line basis. So using makers, we got the factor from the table of 0.1429. That's how we use tax depreciation. And so on the tax return, we'd have more depreciation, so we subtract that. And so our taxable income, after making all the adjustments from our income on the income statement to our taxable income, is $49,649. So that means we're going to record tax expense of 21% of that, right? Debit tax expense and credit taxes payable. So the 10,426 is that portion of our tax situation so far. Then we deal with our two temporary differences. All right. The deferred tax asset, we have the total, since this is our first difference, it's $1,000. That's $210, 21%, and 21% of our liability, because future taxable amounts are a liability. So we have a debit to deferred tax asset, credit to tax expense, and we have a credit to deferred tax liability, and a debit to to tax expense for $445 if you round. Those are the deferred parts. There was nothing to compare them to last year, so we don't have to worry that we had an existing asset or liability that needs to be adjusted. So we calculate what it should be, and we don't have to compare it. Next year, you're going to have that issue to worry about. So on the balance sheet, okay, you could have set up a deferred tax asset and deferred tax liability T account, each one. But on the balance sheet, they are to be accumulated into one and just take the difference. So $235 is what I did in the actual T accounts and on the balance sheet. All right, so speaking of, so that gives us our total tax expense, all the changes to the tax expense T account based on our journal entries for the 21% of the taxable income, and the two together changes in the asset and liability. If you did them separately, that's fine. They will add up the same way. Total tax expense $10,661. That gives us our net income. And now it's time to figure out our shares outstanding. So we started with 10,000 for 3 months of the year. Then it went down to 9,700 when we bought back 300 shares. And then we sold 100 shares. And that was for 7 months, and then sold for November, December, 2 months. So when we multiply out and add them up like we do to calculate WASO, we get 9792. And that's, take our net income divided by 9792, and that gets us our $3.89 for basic earnings per share. While we're there, we can think of our diluted. Okay? since we are the only thing on this that dilutes our earnings per share is the stock options, we'll deal with them first. At this point, all right, if 1/4 of them are earned each year, and it's 1,000 of them, that means 250 was earned in 2018, 250 in 2019, 250 in 2020. That's a total for the year 2020 that we're worried about, 750. So that's 750 options, which means if everybody exercised those options, they would give us cash for each of those 750 shares. So they would pay us 750 times 20, because that's the exercise price, and then we would buy back shares at $26. We'd buy back 571. So the actual difference in shares because of the stock options is 173. So we add that to our 9792, and we divide it by, and the net income divided by that gets us $3.82 for fully diluted earnings per share. Here's our statement of equity or changes in stockholders' equity. We've got the increase in additional paid-in capital from two places, the sale of treasury stock and our stock compensation. We repurchased the treasury stock. We kind of combined it. We had just one purchase there this time. The sale of treasury stock. There was no treasury stock to start with on our beginning balance sheet. We now have the shares outstanding at the time of the dividend, right? We have the 9,800. So 9,800 times 50 cents is our cash dividend. Debit retained earnings, credit cash, and we put our net income, right? We're directly off the income statement, and now we have our ending balances for our balance sheet. Here's what it should look like on your assets, your liabilities. Remember, you could have put the interest in the interest payable instead of the lease liability, which would make this one higher and this one lower by the 693. All right, that's a possibility easily and would still be correct. All right, making sure it balances for 485, 393, liabilities and equity equals our total assets. We do our cash flow, starting with net income, add back depreciation. I put the amortization depreciation in one. You could have separated them. Compensation expense is non-cash because it's stock options. And change in accounts receivable, change in inventory, and you just look at the beginning part of the T account and the ending balance of the T account. You can see the difference for each one of these. I put the deferred tax liability all in one, the change. We paid off the note payable. We bought the treasury stock. That's and sale of treasury stock. That is, these are all finance. We had no investing activities for cash because we got new equipment, we got new building, but both those were leases with no cash involved. So those would both be disclosures as non-cash investing or financing activities, but they do not go directly in the calculations. Sale of treasury stock, paid off the lease. That's how much our lease liability went down. Okay, if you think about the $3,000 minus the interest, and then the dividends. Paid is a financing activity. If you did the interest as part of the interest payable, then you'd have a difference here, and your payoff the lease would be different here, and it still gets your right cash. This is our changing cash, which is, of course, the operating plus the minus the financing because it's negative. Okay, we get our changing cash. We started with $4,000. We ended up with $33,100 on the balance sheet. So that's 2020. Your test 3, is going to be doing the next year. So anything that still exists needs to be considered in the new year, besides the new transactions, the new sales, that sort of thing. So make sure you have this balance sheet specifically correct, because that's your starting point for 2021. So you want to make sure you start with, even if you made mistakes here, you make those corrections so you start with the correct numbers on your balance sheet so you're ready to go in 2021.